Let's take a look at how an IUL works very simply. So we have John. John is you, me, whoever. John is going to be you today, okay? So John goes and earns money. John takes his money and he goes and purchases a life insurance contract known as an indexed universal life. So let's say he takes $1,000 from his monthly income that he generates at work, right? He puts this money into an insurance company's contract. A small percentage of that is going to go towards an immediate death benefit. God forbid something happens to John right away, it'll pay out to his family. If he gets cancer, stroke, heart attack, brain aneurysm, anything like that, he has access to these funds while he's also alive. But let's just say a little bit's going to go to the cost of that. The remaining amount of his money, which is the majority of it, over 90% of his funds, usually go towards an accumulation account, okay? This accumulation account is linked to an external index such as the S&P 500, B&P, Barclays, Nasdaq, whatever you think. 7 to 10% is the average rate of return. There could be years of 20%, 30%, depending if it's uncapped or not. But let's say an average rate of return of 7 to 10%. This account is linked to an index. It's not invested in the index, so therefore it's not subject to market volatility. John can never lose money. It's essentially a savings account on steroids, right? So he only participates in market gains, never loses any money. He's protected for his family with a little portion of his contributions, but this account is going to keep compounding and growing over time. This money pushes over into what we call a cash value account or John's bank. This is where John can take money out of this policy at any time in his life. Does not matter. He doesn't have to be 59 and a half like Joe, who has a 401k, right? John went and got the IUL, so he could touch his money whenever he wants for whatever he wants with no questions asked, right? So this cash value account keeps growing because the accumulation account keeps spilling over. And when John wants to borrow from it, John takes a tax-free loan from his cash value account. He's like, hey, I have this cash in my account. So he goes to the insurance company. He's like, hey, will you guys give me a loan because you could collateralize it with the cash in my account? And then the insurance company is like, yeah, here you go, John. Here's a loan. Go do whatever you want. And if you die, it's okay because we know we'll pay it off with the cash in your account. And then it's also backed by a death benefit, right? So this whole cycle just keeps rinsing and repeating. And if John wants to pay the loan back, if John wants to reverse this and pay his loan back, he's putting it back in his cash account. Therefore, he get access to it again. And all while this is happening, it's never touching the accumulation account. So therefore, this account that has like $1 million in it and $100,000, whatever the amount is, that is still fully indexed, still getting the rate of return because he didn't borrow from that. He borrowed from the insurance company who collateralized it with the cash value in his account. Therefore, he's get uninterrupted compounding growth, one of the only vehicles in the world that allows him to do this, right? And he gets to do it tax-free. He gets to bypass taxes this way. If you want help setting one up, just reach out. We'd be more than happy to see how this could work for you.
Meet John. John's just like you. He works, he saves, and he secretly Googles, how do rich people not pay taxes? One day, John hears about something called an indexed universal life insurance policy. Sounds boring, right? So here's how it works. John takes a chunk of his paycheck, let's say $1,000 a month, and instead of putting it all into a savings account or some mutual fund, he feeds it into this thing called an IUL. A tiny slice of that money goes toward life insurance, so if John suddenly gets hit by a rogue taco truck, his family gets paid. Another small part covers stuff like cancer, heart attacks, or unexpected brain hiccups. But most of that money, over 90%, goes into what's called an accumulation account. This account is linked to big indexes like the S&P 500, but here's the catch, it's not invested in them. So if the market crashes, John doesn't lose a dime. He only earns when the market goes up. No losses, just gains. Think of it like a savings account on steroids. Over time, this account overflows into a second vault, John's cash value account. This is John's personal bank. He can dip into it anytime, not at 59 and a half, not after a midlife crisis, literally whenever. And when John wants to use the money, he doesn't withdraw it. He takes a loan against it, tax-free. Why? Because he's not touching the actual money. He's borrowing from the insurance company, using his own cash as collateral. Meanwhile, the accumulation account is still working behind the scenes, compounding, growing, making money, unbothered. That's the magic of the IUL. John borrows, but never interrupts his compound interest. And if John wants to repay that loan, cool, he can. Then borrow again. And again. It's rinse and repeat. Oh, and when John dies, the loan is paid off by the policy's death benefit. No debt for the family, just a check. So to recap, tax-free growth. no market losses, access to money anytime, tax-free loans, death benefit. If you want help setting one up like John, just reach out. Message at financenurse08 or click the link in my bio to see if an IUL is right for you. Meet Max. Max just wants some cheese. But like most mice, he's been told there's only one safe place to stash it. The government-mandated cheese locker, also known as the 401k. Once your cheese goes in, good luck getting it back. 59 and a half years later, they finally let you nibble the cheese. But wait, it's taxed. Because why let you have your cheese when they can have part of it too? This is Leo. He doesn't chase cheese. He grows it. Leo's cheese is in an indexed universal life policy. No tax when he pulls it. No penalties if he's not 59 and a half. And when markets go up, his cheese grows. Max loses cheese in downturns. Leo, not a crumb lost. Why? Because his cheese is linked to the market but never in it. Max gets sick. 401k says, tough luck. Leo's IUL says, here's cash while you're alive. And when Leo dies, his family doesn't cry over spilled cheese. They get a death benefit. Tax-free. No probate. Just legacy. 401ks are for mice who play by the rules. IULs are for mice who read the fine print. Don't let the government nibble your cheese. Build wealth. Stay flexible. Consider an IUL. Message at financenurse08 or click the link in my bio to see if an IUL is right for you.